Session 1 covers the conceptual framework. The agenda or overview for the session is as follows. We'll start with an introduction, talk about who developed the framework. Then we'll talk about specific areas of the framework, including the characteristics or qualities of financial information, the elements of the financial statements, the bits that make up the financial statements, and how those bits are measured, and the concepts of capital. First of all, the introduction. The IFRS Foundation is the body that was responsible for designing and producing the conceptual framework. They're also responsible for designing and producing all of the accounting standards as well. And the way that foundation works is that there are three sort of subdivisions: the Advisory Council, the ISB, and the Interpretations Committee. The Foundation has overall supervisory responsibility and delegates specific responsibilities to the other groups. The ISB, the International Accounting Standards Board, is actually responsible for issuing, says here issuing the IFRS, the International Financial Reporting Standards, also was responsible for issuing the conceptual framework and providing guidance on the application of everything that has been issued. The Interpretations Committee is responsible for reviewing what's been issued, approving it and making sure that it's effective. The Advisory Council gives guidance on areas where the guidance needs to be updated or changed or new guidance introduced. So IFRS Foundation has overall responsibility. Advisory Council suggests areas that need guidance. The ISB produces the guidance, the Interpretations Committee provides feedback on that guidance, and when we're talking about guidance, that is the conceptual framework and also the International Accounting Standards as well. Two main approaches to actually developing any guidance are a principles-based approach or a rules-based approach. The conceptual framework takes a principles-based approach, gives some general, broad, brushstroke sort of overview guidance that then the individuals within the profession are required to apply to specific scenarios. Gives room for applying professional judgment. The alternative would be a rules-based approach, which would be like a tick list or a checklist of yes/no questions. But the approach that's taken by the conceptual framework is it's a principles-based approach, and the members of the profession need to apply those principles. The conceptual framework is kind of like a general roadmap that gives you guidance as to how to navigate your way around a set of financial statements. And it's a set of widely accepted principles that provide a basis for a number of different things. The principles allow the ISB to develop accounting standards. The basic principles allow the users to actually understand and interpret those accounting standards. The framework also establishes the nature and the purpose of the accounting standards and accounting guidance, and sets the parameters rather than limitations, I suppose, but it certainly does that too. Specific purpose of the framework is to help. Helps the ISB in developing the International Financial Reporting Standards. Every single accounting standard that is developed will be developed with the framework in mind, using the basic principles that are included in the framework. If there is no specific accounting standard that relates to a particular transaction or a particular event, then the conceptual framework will give guidance on what to do in those particular circumstances and give guidance on how to set accounting policies. If a particular accounting standard permits a choice of different ways of doing things, a choice of policy, the conceptual framework will give guidance on not necessarily which policy is more desirable, but certainly whether those policies are acceptable. And consequently, the framework will also help the stakeholders, the people that use financial statements, of which there will be a number, helps the stakeholders actually understand what's going on. There are a couple of other basic concepts that underpin the framework as well. There's the concept of accrual accounting, which you've probably come across in previous studies. Accrual or accruals accounting is used in preparing all of the financial statements. And as a second bullet point down there says, Income and expenses are incurred in a particular period. The period in which the income is incurred is not necessarily going to be the same as the period in which the cash is received. The period in which the expenses are incurred is not necessarily going to be the same period in which the cash is paid out. And a company should apply the accruals concept and record transactions and events in the period to which they relate, not necessarily the period in which the cash has changed hands. This is also known as the matching concept, simply because if there's income and expenditure that are related to each other, then they need to be recorded in the same accounting period as well. That's why we do things like depreciate a non-current asset. We spread the cost over the income generating period so that the expense is matched with the income that you generate from that particular item. So accruals accounting underpins all of your financial statements, and accruals accounting is a fundamental concept included in the conceptual framework. There is also another underlying assumption. The underlying assumption is that of going concern. All financial statements are prepared on a going concern basis, unless you have a really good reason for doing otherwise, and certainly as far as this paper is concerned, that will not be the case. So the underlying assumption is the going concern concept applies. This assumes, second bullet point, that the entity will continue its operations for the foreseeable time period, for the foreseeable future. That is normally estimated to be a year. This means that the company has no intention to cease its operations. So the assumption is continuous trade. However, in the unlikely event that the company is not going to be around for a year, the going concern concept would obviously not apply. The accruals concept and the going concern concept are underpinning all of your sets of financial statements, and you use them unless you have a good reason for doing otherwise. There will never be a good reason for not using the accruals concept, and there will hardly ever be a good reason for not using the going concern concept.